What is a DIF score? In today's episode, we learn about the most important financial score that you've never heard of. Hey everybody, Peter Billigus here for the Peter Billigus channel, where we always, hopefully, make finance fun. You know, there are many ways the financial industry evaluates us. Banks will look at our credit scores to determine if they want to give us a loan. Companies like TransUnion, Experian, Equifax, and the Fair Isaac Company, or FICO, help to compile our credit reports and credit scores. Banks also look at something called your check systems report. Like a credit report for bank accounts, your check systems report is summarized into something known as your Qualifile Score. This score is typically on a scale from 100 to 899. The higher your score, the better. And what this score does is it helps a bank determine whether or not they're going to let you open a checking account. The score and check systems report reveal how many bad checks you wrote, how often you have overdrafted, and whether you have ever conducted any fraudulent activity. So we have your credit score, which is based off your credit report, and helps banks to determine how likely you are to pay back the money that is lent to you. And we also have your Qualifile Score, which is based off your check systems report, and this helps banks determine if they should let you open a checking account. Now, most people know they have a credit score. Most people don't know about Qualifile and check systems, but really that score doesn't affect most people unless you are seriously bouncing checks or doing some nefarious dealings. But there is another score, one that affects you drastically that many people don't even know about. It's called a DIF score, and it's the score that the IRS uses to determine if you will get audited. The DIF of DIF score stands for Discriminant Functions System Score. I know that acronym doesn't perfectly match up, but what this score actually measures is the probability that there would be a change if the IRS looked closer at your tax return. A high DIF score means that if the IRS did audit that return, they would most likely find something that wasn't right. A low score means that even if they did look closer, they would most likely find out that the return was prepared correctly. Right behind the DIF score is another score known as the Unreported Income DIF score, or UI DIF score. The UI DIF score rates the return for the potential of unreported income. When a return scores high on the DIF or UI DIF scales, it means that the IRS is likely to find something you did wrong, which usually means more money that you owe to them. So what's in a DIF score? Well, no one, except a small number of folks at the IRS, actually know. There are people on the internet that claim to have reverse engineered the DIF score, but it's hard for them to prove their research because the formula is kept secret. When the IRS was creating the score, they actually subcontracted several different companies to create parts of the score. So no one company knew exactly what was in all of it. By the way, the government did the same thing on the Manhattan Project. Some of the engineers on that project didn't even know what they were working on until they heard about the first bomb being dropped on Hiroshima. Even though there is no way to know exactly what is in the DIF score, there are certain logical assumptions we can make. So what can raise your DIF score? In other words, what increases your chances of getting audited? Well, anyone who falls into these categories: people who are self-employed, anyone with an all-cash business, like a taxi driver, exotic dancer, or an exotic dancing taxi cab driver. I actually hear they're hiring. Very high income earners, people who claim a lot of cash donations to charity, day traders, people who claim the home office deduction, and whether you have ever been audited before by the IRS, and if that audit was financially successful for the IRS. So what lowers a DIF score? Well, the good news is that there are things you can do that can lower your DIF score and thereby lower your chances of getting audited. Most notably, working with a professional, either a certified public accountant or an enrolled agent. Working with the same professional year after year also helps. Often people hop from professional to avoid paying their fair share of taxes. But if you stay with the same person, that will help. Having never been audited before also helps. Remember, it costs the IRS money to audit someone. So if they do want to double check someone's work, they want to stack the odds in their favor. They want to know that they're going to find something if they look more closely. Now, I know people are worried about getting audited. People say to me, Peter, I am worried I'm going to get audited and the IRS is going to take everything that I own. and I'll be forced to wander the streets with nothing except a tattoo across my chest that reads, "Seriously, Hollywood? Has there been literally no progress on Spaceballs 2, The Search for More Money?" The reality is, unless you are making millions of dollars every year, your chances of getting audited are probably less than 2% per year. And even that statistic is skewed because the people who do get audited usually have something in their return anyway that raises the DIF score, something like the home office deduction or large cash donations to charity. Sadly, there is not a ton of stuff you can do to outsmart the DIF score. Number one, we don't know exactly what's in it. And number two, some of the stuff that we do know that's in it, well, you'll want to do that anyway. If you qualify for the home office deduction, you should take it. If you made a cash donation to charity, well, you should deduct those cash donations too. You shouldn't live in fear of the IRS. Deductions exist for a reason. The government wants you to buy a home, go to college, start a business, and donate to charity. I don't know what they do at this charity. One thing I do recommend is working with a qualified professional if you are a small business owner, because some people think they can deduct stuff that they actually can't, such as certain items of clothing. If you work with a professional, they'll be able to guide you on the do's and don'ts. And if you ever do get audited, do not talk to the IRS unless you are represented by either a certified public accountant or CPA, an enrolled agent, which is someone who is licensed to represent you in front of the IRS, or a tax attorney. Lastly, I also recommend people move away from the concept of tax preparation and move toward the concept of tax strategy. So often, and I'm guilty of this, we scramble to just get our taxes done. But thinking ahead a year or two or more about how to reduce our taxes, that is the place that we want to be. For the moment, just realize there are many scores that try to summarize your financial life, but the DIF score is one that few people have ever heard about. Even fewer people know about the UI DIF score, but they do exist. Don't worry too much about them, because there is little you can do outside of staying organized, using a professional, and thinking about tax strategy as opposed to just tax preparation. If you absolutely hated this show, please be sure to hit the like button anyway and subscribe. And if you have a question I should answer, please let me know in the comments below. I'm Peter Billigus. Thanks for watching.